Good afternoon and welcome to NYFP. On this Friday afternoon, the major U.S. stock averages are appearing earlier session weakness. We are seeing the Dow and S&P 500 down just minus 0.1%. Joining me now is Peter Cardillo of Rockwell Global Capital. Peter, good afternoon. Thanks for joining me.
Good to be back.
Well, the week is about to come to an end. We got the Fed rate decision as well as announcement earlier this week, and then we got the jobs report. Now, the headline number did disappoint, but we did see the unemployment rate decline. But we do have to keep in mind that the labor participation rate is also lower as well. So overall, what do you make of the data?
Actually, the data wasn't a surprise to me. I was looking for about 168,000 non-farms, and it came in at 162,000. So basically, it was just within my parameters. And of course, if you really take a hard look at this report, it was a lot weaker than the headline number really suggests. And here is the reason why I say that. If you look at the average worker week, that was actually down. Salaries for the first time in many months were actually lowered. And so that indicates that the labor market, while it is growing at a moderate pace, it is certainly not ready to take off at a point where we can see unemployment rate really come down and where the Fed would have to begin to trim on its bond buying program. So I think, this suggests that the Fed is off as far as September is concerned. And of course, I've been saying that they would probably begin trimming either at the end of the year or possibly in the first quarter of 2014.
Peter, you're right. The jobs number in terms of the headlines and even finer details were disappointed. We also got downward revisions for non-farm payrolls in the previous 2 months as well. And all eyes were on this report because of a better idea of when the Fed would begin tapering its bond buying stimulus, and I think you've been giving us your predictions. And it does appear as though even economists who had been expecting something, even if it was just a little bit of a pullback in terms of the bond buying program, their expectations have eased as well. And now that we're at close to record highs, even though we're seeing a slight pullback in terms of the equity markets, do you think it'll be quiet for the rest of August?
Today's action, I expected this, and it's nothing. It's just a little bit of a pullback. We made new highs yesterday. The S&P closed above 1,700, and going into next week, we have a very light week in terms of economic data. There are only two major key reports out next week, and that is, of course, the ISM Service Index, which should show steady growth, but nothing that's going to be excessive. And of course, we have the trade deficit. Now, the trade deficit should reflect stronger export sales, so we're calling for about $42 billion next week, which would be about $1.5 billion lower from the previous month. So all in all, I think there'll be a lot of debate on the employment number next week. The post data will probably make for a nice rally. I can suspect that the market is going to do nicely during the month of August. Maybe not as vivacious as we have seen in July, but I think next week it'll probably be a week where the market responds to the fact that the Fed is not going to pull back on stimulants in September. So the rally continues.
And Peter, before I let you go, we talked about the Fed and the U.S. jobs report, but we also had the ECB and BOE rate decision earlier this week. Next week, we get the BOJ and the RBA. But regarding the European Central Bank, although we are slowly seeing an economic recovery, there are still a lot of problem areas in the Eurozone. So what did you make of the comments, and what is your outlook?
Yeah, indeed, and there was a rate hold both from the ECB and from the Bank of England. There was no changes, and I kind of suspect that Mr. Draghi, went out of his way once again to say we're going to continue for a while longer. He's made no commitments, even though there are signs that perhaps we can see a reversal of the recession in Europe, perhaps in the beginning of the first quarter of 2014. But Mr. Draghi continued on the litany of reasons why the ECB is going to stay on hold. And again, it goes back to slower global economic growth here in the States that's improving, but not to the point where it could impact a change in monetary policy, and that obviously would impact slower growth in Europe.
Okay, Peter. Well, thank you so much for joining me at the beginning of a busy week, and thanks for your insight as always.
My pleasure.